Thank you for joining today's webinar. My name is Sutha Kanagarajah and I am a Senior Tax Manager at Cordium. Today we are going to talk about the Offshore Fund Tax Regulations, a set of rules that is relevant to UK investors who have an interest in an offshore fund. There should be some time at the end of the presentation to answer questions, and you should be able to see a questions area on the GoToWebinar console, as we have here on this slide. You can submit your questions through here. If we don't have time to answer all the questions, I will try to respond to you directly by email or by call. So today's webinar is about the offshore fund tax rules, relevant to UK investors who have an interest in an offshore fund. As such, fund managers should also be aware of these rules. The offshore fund rules were first introduced in 1984 and have had various adaptations. In December 2009, the rules were replaced by a new regime, but the overall objective has remained the same. Essentially, these rules are an anti-avoidance provision, and the reason for these rules is due to the difference in tax rates for income and capital gains. Income is a receipt produced by an investment, such as dividends from shares and interest from debt instruments. Capital receipts are normally proceeds arising from a disposal of an asset held for investment purposes. So the asset in a fund context is normally equities or debt instruments. In today's webinar, we will cover the purpose of the offshore fund rules, the definition of an offshore fund, and the reporting fund regime. The purpose of these rules is to prevent the avoidance of UK income tax liabilities through the use of an offshore investment vehicle. For example, suppose we have a UK resident investor who invests in a Cayman corporate fund. The Cayman fund then invests in bonds or equities and starts to receive income on its assets. The fund does not distribute its income, but instead, income is accumulated in the fund. The tax rate in Cayman is 0%, so there is no tax charge on the fund in Cayman. The highest UK income tax rate is currently 45%, but as the fund does not distribute its income, the UK investor will not incur a UK income tax charge. However, the UK investor can extract his investment income by redeeming his interest in the fund. When he does this, the gain, i.e. the difference between the net asset value on redemption and the cost of acquiring the interest, in the absence of these rules, would have been taxed at capital gains tax rates. The highest rate of capital gains tax is currently 28%. So here, the investor has used the Cayman fund to roll up income and extract that income at capital gains tax rates rather than the higher rates of income tax. As mentioned before, capital gains tax is currently 28%, and the highest rate of income tax is 45%. To tackle this, the offshore fund rules treat such gains as if it were income. So if you dispose of an interest in an offshore fund, the gain is treated as income rather than capital, and therefore taxed at rates up to 45% rather than capital gains tax rates of up to 28%. If, however, the offshore fund enters the reporting fund regime, then a redemption would attract capital gains tax rates. We will talk about the reporting fund regime later. Let's now talk about the definition of an offshore fund. An offshore fund is a mutual fund which takes one of three forms: a non-UK resident body corporate, a foreign trust, or any other arrangement but not a foreign partnership. A mutual fund is one that satisfies three conditions. Firstly, it must enable investors to participate in a fund that holds assets or receives income from assets. The investors must not have day-to-day control of the management of the assets held by the fund. And finally, a reasonable investor can expect to realize all or part of the interest at an amount by reference to net asset value. So you can see that collective investment schemes, as defined by the Financial Services and Markets Act 2000, will fall within the meaning of an offshore fund. Prior to the new regime, the definition of an offshore fund excluded closed-ended funds. This meant that it was possible to structure a fund so that it was a closed-ended entity when the arrangements had the characteristics of an offshore fund. Under the new regime, closed-ended entities can also be an offshore fund, as you can realize NAV on a winding up of the entity. In general, therefore, if it feels like an offshore collective investment scheme, then it's likely to be within these rules. There is, however, an exception for closed-ended funds where the NAV on winding up is not predetermined. For example, a Luxembourg SAL that owns German real estate investments would not be treated as an offshore fund if there is no predetermined date on which the SAL will be dissolved. There is also an exception for private equity funds. This is where the sole or main purpose of the offshore fund is to invest in qualifying companies. A qualifying company is defined as a trading company or the holding company of a trading group or a trading subgroup where the shares of the company are not listed on a recognized stock exchange or admitted to trading on a regulated market, and the activities of the trading company do not include investment transactions. We mentioned earlier that foreign partnerships are not within the offshore fund rules. This is because a partnership is normally transparent for tax purposes. This means that investors are taxed as if they held the underlying assets of the partnership directly and received the income directly. As such, it would not be possible to roll up income and take it out at the rate of tax for capital gains. Hence, the offshore fund rules are not relevant here. You can, however, have structures that are transparent for income tax purposes, but opaque for capital gains tax purposes. These type of semi-transparent entities include unit trusts and SCPs. A semi-transparent entity could be used to roll up income in a special purpose vehicle. Suppose, for example, an investor holds an interest in a unit trust, which in turn holds an interest in a special purpose vehicle, say another collective investment scheme. As the income is rolled up in the SPV and is not distributed to the unit trust, the investor is not taxed on this income. When he sells his interest in the unit trust, then because the unit trust is opaque for capital gains tax purposes, the investor is subject to capital gains tax on its disposal. However, the disposal proceeds are generated by income that has been accumulated in the SPV. So the offshore fund rules are relevant to these arrangements, as clearly semi-transparent entities could be used to roll up income and achieve capital gains tax rates. Under the offshore fund rules, a gain on a disposal of an interest in such entities by the UK investor would be subject to income tax. There is an exception, and this is where less than 5% of the semi-transparent entity's assets consist of non-reporting funds. A non-reporting fund is one that is not within the reporting fund regime, and a gain accruing to a UK investor from a disposal of an interest in a non-reporting fund is subject to income tax. When a fund enters the reporting fund regime, investors who acquire an interest in a reporting fund would achieve capital gains tax rates on a future disposal of their interest. For those investors who held their shares prior to it becoming a reporting fund, the gain on disposal will continue to be taxed at income tax rates unless they make a special election. This special election needs to be made in the tax year in which the fund becomes a reporting fund. By making this election, the investor is treated as having disposed of his interest in the non-reporting fund and acquiring an interest in a reporting fund on the day that it joins the reporting fund regime. For example, a fund has an accounting year ending on 31st December 2015. A UK investor acquired his shares in the fund on 1st of January 2014. The fund converts to a reporting fund on 1st of January 2015. The UK investor elects to be taxed as if he had disposed of his non-reporting fund shares on 31st December 2014, i.e. the day before it becomes a reporting fund. The income gain is included in the UK investor's tax return for the tax year ended 5th of April 2015. However, he is treated as having acquired shares in a reporting fund on 1st of January 2015. Going forward, a gain that arises on a future disposal of the reporting fund will be taxed at capital gains tax rates. Whilst the disposal of an interest in a reporting fund can achieve capital gains tax rates, the downside to the reporting fund regime is that UK investors are taxed on their share of the fund's undistributed income. The rationale here is that the purpose of the offshore fund rules is to tackle the avoidance of income tax using investment vehicles. So there is a cash flow disadvantage here because you are taxed on an amount which you have not yet received the cash for. However, when you dispose of your interest in the reporting fund, the accumulated income which you have previously been taxed on is deductible against your redemption proceeds, thereby reducing the amount of your gain that is subject to capital gains tax. If the fund invests primarily in equities, the undistributed income is taxed at the UK's dividend tax rates. The current effective rate of tax for dividends is 30.6%, but under the proposals from the recent July budget, this is going up to 38.1%. If the fund invests primarily in bonds or other debt securities, then the undistributed income is taxed at the normal income tax rates, the highest being 45%. The illustration here shows the difference in tax terms between a non-reporting and a reporting fund. In this example, the fund is a non-distributing equity fund. A UK investor acquires his shares in the fund when its NAV is 100,000. Each year, the NAV increases by the amount of income that has been accumulated. If this was a non-reporting fund, the investor is only taxed when he redeems his interest in the fund. So in this example, he is subject to income tax at 45% on the difference between his disposal proceeds of 350,000 and his acquisition cost of 100,000. The total income tax on this gain is 112,500. If it were a reporting fund, then the UK investor is taxed on his share of the undistributed income each year. So in year one, the undistributed income, referred to as reportable income, is 50,000, year two, 37,500, and year three, 92,500. As the fund invests primarily in equities, the investor is taxed on his share of the reportable income as if it were a dividend. In this example, we are assuming the new dividend rate of 38.1%. Over the period he holds his shares in the fund, he incurs an income tax charge of $68,580 on the reportable income. When he sells his interest, the gain is subject to capital gains tax at 28%. When calculating the capital gain, we also deduct the total amount of reportable income which has already been taxed on. So here, his capital gains is his proceeds of $350,000, less his acquisition cost of $100,000, and the total reportable income of $180,000. This gives a capital gain of $70,000 with capital gains tax at 28%. So you're looking at capital gains tax of $19,600. In total, the tax suffered as a reporting fund is $88,180 compared to just over $112,000 if it were a non-reporting fund. A fund can enter the reporting fund regime by making an application to HMRC. The application must be made by the later of the end of the period of account or 3 months from when the interest in the fund became available to investors. Once an application has been approved, the fund is recorded on a list of reporting funds maintained on HMRC's website. Each year, a reporting fund must submit to HMRC a reportable income tax computation and a report to investors. The reportable income is effectively the undisputed income in the fund. The reports must be submitted within 6 months from the end of the accounting period. So for a December accounting period, the reports must be submitted by 30th of June. There is a grace period of 4 months where the deadline is not met. We would work closely with investment managers and the administrators in preparing the reporting of income tax computation and the report to investors. The challenge for fund managers is ensuring that audits are completed within sufficient time so that the reportable income tax computation and report to investors can be prepared and submitted within the 6-month deadline. Fortunately, there is the 4-month grace period, but as always, it is best practice to submit within the 6-month deadline. Calculating the reportable income. The starting point for calculating the reportable income is the total comprehensive income for the period, where the fund prepares its accounts in accordance with international accounting standards or its equivalent where IAS is not used. We then adjust the starting point for capital items, special classes of income, and equalization arrangements to get to the reportable income figure. Capital items are expenses directly related to the acquisition or disposal of a fund's investments and net gains on investments. Where a fund is trading as opposed to investing, a profit from a trade would not be treated as a capital item and will therefore remain within the reportable income computation. Special classes of income include income from other reporting funds or non-reporting funds, effective interest adjustments, and income from wholly owned subsidiaries. As mentioned in the previous slide, net profits from a trade are not adjusted for in the reportable income tax computation. Therefore, the reporting fund regime will not be helpful to funds that are trading as opposed to investing, as otherwise, UK investors would be taxed on substantial net trading profits, as this forms part of the reportable income tax computation. There is no precise definition of trading in UK tax law. Case law on the subject of trading is mainly in the context of manufacturing, and typically, the factors pointing towards trading are a high frequency of transactions and the motivation of a transaction from the outset. As there is little precedent in the context of investment management, it can be difficult to conclude whether or not a fund is trading. There is a list of transactions which HMRC accepts as being non-trading in nature. Offshore funds can rely on this list, provided that the fund meets the equivalence and genuine diversity of ownership conditions. The equivalence condition will be met if the reporting fund is recognized by the FCA under sections 264, 270, or 272 of FSMA 2000. UCITS funds should meet this condition, and non-UCITS may meet this condition if they are recognized schemes in the UK or where they are EEA schemes authorized by the relevant domestic regulator. The genuine diversity of ownership condition is met if broadly the fund is marketed and made available to intended investor categories. The list is helpful as it gives an indication of how HMRC would consider a fund's activities. To summarize, tax suffered by a UK investor should in principle be less where a fund is a reporting fund compared to a non-reporting fund. Investors will need to weigh up whether or not the tax saving is worth the cash flow disadvantage of having to pay tax on undistributed income. However, if the fund is distributing its income as dividends, then no such cash flow disadvantage may arise. Fund managers need to also consider whether or not the fund is trading. If the fund is trading as opposed to investing, then the fund's gains on its assets would constitute income, and so this could create substantial income tax charges and a cash flow disadvantage on amounts not yet received by the investor. It is not always clear-cut to determine whether a fund is trading or not, but certain funds, in particular UCITS funds, can rely on the whitelist of transactions. Where trading versus investment is not clear-cut, a separate share class could be offered to investors who prefer reporting fund status, with a separate share class for those that prefer non-reporting status. This is because, for the purpose of these rules, a share class is treated as an offshore fund in its own right. So these rules do offer flexibility to investors who have specific preferences. To conclude, a fund manager can make a fund more attractive to its UK investors by taking advantage of the reporting fund regime. A reporting fund can add real value to the fund as an investment opportunity, and failure to take it up could represent a competitive disadvantage. We have a team that works closely with fund managers and administrators. We advise on whether or not reporting fund status is relevant to a fund, applying for a reporting fund status, and preparing the reporting fund computation and report to investors. So you can contact any of us listed here if you'd like further information. Thank you for listening. We do have a bit of time for a few questions. We do have a bit of time for a few questions, and to help answer these questions, I'd also like to introduce you to our Head of Tax, John Davison.
Hi there, good afternoon everyone, it's John here. I don't know if you want to deal with any of these questions first, or do you want me to go straight on to what I've got here? Just a couple of questions that have come in just in the last few minutes, and I'll try to sort of answer them as best I can. The first one is, somebody's asked if a Cayman fund of hedge funds would be defined as an offshore fund. And the sort of short answer to this is yes. If this is it's an open-ended investment company investing in other open-ended investment companies, then essentially it's a net asset value type investment, and it would be within the regime. And the regime does accommodate both funds of reporting funds and funds of non-reporting funds. So calculations may be a little complicated, but it will be within the regime, and it may be possible to get reporting fund status. Another question which has come in is whether a US partnership structure would be, whether it would be within the regime. Essentially, this I think we're talking here about a completely transparent vehicle, and so the treatment of such an arrangement would be as if, essentially, as if the investors had invested directly into the underlying investments. So the scheme probably wouldn't be relevant. And there was a supplementary question there about whether or not a portfolio of US partnership structures could be sort of mapped through to the regime. Now, I think the regime would probably not be relevant where you've got a completely transparent arrangement. So this is really relevant where the income doesn't directly flow to the investor as a matter of law. It's where the vehicle into which the investment is being made has itself a sort of personality, so that the income can accumulate in there and then has to be recognised by the investor under the regime to get the capital gains tax treatment. So that's I think that's all we've got there. Okay, thanks. You're welcome. So I've just got a confirmation that question's been answered, so thanks for that.
Okay, we do have another question here, and the question is, when is reportable income included in an investor's tax return? I'd like to bring on one of our tax managers, Shilpa. Shilpa, could you respond to that, please?
Yes. So, when is reportable income included in investor's tax return? Okay, the reportable income is deemed to have been distributed 6 months after the end of the fund's accounting period. So if the fund has, for example, 31st December 2015 year end, the deemed distribution date would be 30th of June 2016, as this falls within the tax year ended 5th of April 2017. It would go into the investor's tax return for that tax year, so 2016-17.
Thank you, Shilpa. And another question we have is, if a disposal of a non-reporting fund results into a loss, is this treated as an income loss and therefore deductible against income from other sources? So the answer to that is, basically, you cannot have an income loss on the disposal of an interest in a non-reporting fund. Instead, the loss will be treated as a capital loss, which is deductible against capital gains. So you cannot have an income loss on the disposal of a non-reporting fund. Instead, it will be treated as a capital loss. I think that's about it for now. If there are any other questions which have come through that we haven't had time to answer, I will try to email you or call you directly. This now ends our presentation. Thanks again for listening.